good afternoon, and welcome to our Atleha-edu dialogue on real assets. Today we'll be focusing on private equity. But before we get started off, I'm Sandy Nelson. I'm the administrator, or one of the administrators of Atleha-edu, and also a ESG analyst at Six Capitals. So firstly, I'd like to thank Fairtree and CISA Foundation for funding today's dialogue and the rest of the Real Assets dialogue series. Without them, this would not be possible. So we would like to just once again extend our gratitude to Fairtree and the CISA Foundation. So before we go any further, I'm going to hand over to my colleague, Tuma Dube, who will be covering today's content, just to give him or introduce himself, and then we'll take it from there.
Good afternoon, everybody, and thank you for joining our dialogue today. My name is Tuma Dube, and I am an ESG specialist at Six Capitals, as well as a facilitator within Atleha-edu for these dialogues, as well as the workshops that we conduct with the help of our partners that include Fairtree and the CISA Foundation. Working as an ESG specialist on a day-to-day basis, serving primarily private equity firms, listed corporates, just in understanding their ESG risks and opportunities. And very excited today to talk to you all about real assets, with a particular focus on private equity's role in facilitating access to some of these investment opportunities.
Thank you. Thanks so much, Tuma. So before we go any further, there are some of you who have joined many of our online dialogues before or our in-person workshops, and you have a view of what it is that we do at Atleha. And then there are some of you who might not have. So I'm just going to be playing a short video to give you an overview of Atleha-edu. And this video will just shine some light on what it is that we do and what our aim is at Atleha-edu. Thank you. So that was just a short overview of Atleha-edu and what it is that we do. So once again, this entire dialogue series on real assets was made possible by FA3 and the CISA Foundation. And without any further ado, we'll be handing over to Tuma to take us into today's content. Thank you.
Okay. Thank you, Sandy. I'm just going to ask that you enable that I'm able to share my screen so that I can share the publication that will be the basis of our conversation today.
Okay. Here you go.
Yes. There we go, indeed. Right. So the basis of our conversation just around understanding real assets will be based on one of the publications that we have, as you saw in the video. That we have quite a few digital publications that we make freely available in order to be able to go through some of the concepts that we talk about in these dialogues, as well as in some of the workshops that we host with our funding partners and for the funds that participate in these programs as well. And the one that we're going to be talking about today is real assets, and particularly private equity's role within that asset class as well. What all of that means, and how this has changed as well, particularly with the promulgation of Regulation 28 in the recent past. So real assets doesn't assume that there are any fake assets, but what we are talking about here is tangible assets that you can see, touch, feel, as well as to be able to hold these assets. And these are, of course, if you want to look at the other side of that coin, you would be talking about financial assets like securities. So shares in a company that's listed on the JSE, whether you're investing in an ETF that gives you access to government bonds and the like. All of these are called financial assets. And these aren't tangible things, tangible buildings, or things that you can collect and take delivery of physically. And that's how we then distinguish between what we mean by real assets versus financial assets. All right. And so the definition is also provided in this publication here, is that these are tangible investments that have an intrinsic value because of their substance as well as their physical properties. And they are a great way in which to diversify an investment portfolio, because they are not correlated to, or they do not follow the movements of the stock exchange, and which is something that we'll talk about when we address the questions of why would we even want to invest in real assets. And just to illustrate the point about these being tangible physical assets that we can invest in, we have some examples of real assets in this publication here. When we're talking about real assets, we're talking about properties. So buildings, whether that be residential property, commercial property, industrial property, all of that can be classified as a real asset, and the type of that being property, of course. And we're also talking about infrastructure. So we're talking about roads, we're talking about the infrastructure that delivers water, gas, and electricity into our homes and into our businesses. We can even talk that about the trains that we ride on our way to work, or within the inner city to run our errands, and the like. All of this infrastructure is also classified as a real asset. We're also talking about commodities like gold, silver, crude oil, natural gas, as well as agricultural products like wheat and corn and even livestock. All of these are classified as commodities, as well as then they being real assets as well. And of course, we've got natural resources as well. So these could be the water rights, coal, iron ore as well, mineral deposits that are below the earth that we that we also classify as real assets. And lastly, collectibles. Some high net worth individuals would like to invest in rare art, for instance, as an example, in order to be able to diversify their investments in that way. And because these things are so rare, they also generally increase in value over time, and so can also earn you a financial return. But these are physical, tangible things as well, and this is why we can also refer to them as being real assets. So why would we want to learn about real assets? Why would we invest in real assets? There's a number of reasons. The first, and I think one that is quite pertinent in our times, is that these can offer some great protection against inflation. So as the cost of goods and services increase, real assets are largely unaffected by these in terms of the return that you can earn on them, as opposed to financial assets where the buying power of your rand can be reduced by the impacts of inflation, as well as when we see inflation go up, we generally see the value of real assets also increase. But when we talk about financial assets and we talk about equities, for instance, we can see the share prices of some assets in the financial markets, like in listed companies on the JSE, might be impacted with valuations going lower because as they cost of their goods and services increase, you can generally expect that fewer and fewer people will want to buy those things, or to pay for those services, and therefore that can also harm the profitability of those companies and ultimately the free cash flow upon which we base most of our valuations of those companies as well. Also, because of what we've mentioned just briefly as to why real assets are a great way to diversify a portfolio. And by diversification, what we generally mean is that you don't want to put all your eggs in one basket. You want things that are not correlated to one another. So if you are losing in one area of your investment portfolio, the hope is that you are winning in another. And real assets can provide some of that in the sense that when the stock market goes up or down, real assets are generally unaffected by that volatility, and therefore can provide some benefit there when times are tough in the areas of your investment portfolio that holds a lot of financial assets. They also can provide a steady income, or offer a steady income stream in your investment portfolio. And a good example of that is rental income out of property that you can earn while you hold ownership of that real assets. And they are generally stable investments, in most part, in terms of the fact that their growth in value is largely predictable, largely stable, and therefore you more often than not, you won't be surprised by a drop in value that is dramatic over a single day, or just a violent increase in that value. And a great example of that, if you remember, with the Steinhoff scandal, losing 90% of its value in a single day. You're unlikely to see that when with your investments in some real assets. And another great reason why we want to learn more about real assets and would like to invest in these is that they do offer some long-term growth, and like we said, generally increase in value over time, largely unaffected by the ebbs and flows of the stock market, as well as providing some protection against inflation, make them a very good investment as part of your broader portfolio. A great way to diversify it, a great way to earn a stable and steady income, as well as a great way to protect yourself from many of the risks that the financial assets might be exposed to. And so I guess then the next very important question would be, what are some of the ways in which we can invest in real assets? And for pension funds, how much of the pension funds under management can be invested in real assets. Well, there's a number of ways in which the pension fund can do so. And this we take, and we'll start with that question first. And this we take guidance from Regulation 28 in terms of understanding how much exposure can a pension fund have to real assets. And Regulation 28 does set some limits on how that money can be invested. It provides that 15% of that can be invested in private equity. Private equity are generally companies that will set up a fund with a very specific investment strategy. And some of these private equity funds are very specific in saying that they only invest either in properties and the types of properties they will list there, or they say that they are an infrastructure fund, so they only invest in infrastructure assets, remembering that these two types of real assets, these two types of assets fall under this umbrella of real assets. So that can be one way in which the pension fund can get some exposure into some real assets through allocating some of its capital to private equity funds that are specializing in making investments into that space. Pension funds can also invest directly into property, and 25% of those assets under management can be invested in that way. We also know that 45% can be invested into foreign investments. This can also include some real assets, but that are not in South Africa or in the local market. And so that's another way in which we can gain some exposure there, as well as 45% can be invested in infrastructure projects. And we've just highlighted that as a very specific type of real asset that we can invest in as well. But also on the JSE, while we've drawn the distinction between real assets and financial assets, there are some companies that are listed on the JSE called real estate investment trusts, called REITs for short. And these are those companies that own commercial, residential, industrial properties, and that you can invest in as well as part of your listed portfolio in order to gain some exposure to some of those underlying assets that are held by these companies who have then ultimately then listed their shares on the JSE for them to be publicly available. And there is a distinction between a real estate investment trust versus a property fund, which you'll generally find under the private equity setup. And it will be key to understand that in deciding how to allocate those funds between the two. And deciding between property funds and REITs is like deciding between investing, let's say, in a unit trust or buying individual shares, in the sense that a property fund will usually just consist of various underlying real estate companies, shares and REITs as well. And a REIT is typically managed by a single company that then just acquires and manages various real estate assets. So various property types will be found, but in a single company, whereas a property fund might invest in many companies, which then also have maybe underlying real assets within their portfolios as well. So depending on what you want to achieve with your investments, depending on your investment strategy as well, that could be an important distinction to make when deciding what to allocate where. If the decision is between investing in a real estate investment trust that is listed on the Johannesburg Stock Exchange, or investing in a property fund, which could either be listed or be in the private equity type scenario, where you are investing in that manager to allocate that capital to various companies that might hold property and real assets within its portfolio. So there are a number of differences as well that we can draw on here between the two. And the first is the types of properties that can be invested into here. Traditional property investments, these could be your residential homes, commercial properties, and land. These are things that we're all very familiar with, that have been part of our lives for decades, that we understand about how to invest in these, what to look for, and how we expect those to behave in terms of the risk and the return that we seek to earn. How do we earn an income from these, as well as how long do we need to hold that investment in order to achieve the type of return that we had set out to achieve in our investment strategy. But there are now, as the world changes, some alternative property investments. We're seeing the rise of co-working spaces. We're seeing the rise of commercializing libraries, and shopping centers are being built in rural and informal areas. We're seeing the development of mixed use developments where you've got housing, you've got commercial, like a shopping center, where maybe you even have a service station within this one development, where you've got offices. And sometimes, if it is large enough, you can have a hotel and you can have a hospital in there as well. This is mixed use development where you can live, work, and play in a single development. These are some of the new alternative property types that are emerging or have emerged within the market. And we're seeing that there's a lot of growth of shopping centers, so retail developments in rural and informal areas where a lot of the growth is happening for those types of investments, where developers are wanting to bring some of these services to underserved and unserved markets to drive job creation, as well as part of those investment decisions that they have made in order to enter into an area like that. And private equity is another great way, which is a sort of the focus of our conversation here today, to gain access into some of these developments, because these are generally not listed on a stock exchange. And with the Regulation 28 increasing some of the limits in terms of what you can allocate to private equity, does present then an opportunity to get exposure to some of these new types or these alternative property investments that have become available, in order to maximize the returns, to diversify the portfolio, as well as to provide protection from some of the volatility that we've seen in the stock exchanges, particularly in the post-COVID world. You want to be able to protect as much of your investment returns as possible by diversifying in very smart ways that gives you exposures to some of these generally stable, generally uncorrelated investments. And by uncorrelated, meaning that they are not affected to a great extent by what's happening in the stock markets as well. So we talk a little bit now about some of the innovative property investments that we are seeing emerge in the market. We spoke just now quite briefly about these alternative property types that we've seen come on steam, how pension funds are gaining access to some of these property investments by allocating to private equity in order to make these investments. But we are seeing some new types of property. The ones that we're used to, of course, being commercial, residential, and maybe some warehouse, as well as some retail. These are the ones that we're used to. We're seeing commercial also now take different shapes and forms by the development of co-working spaces. We're seeing retail properties, so shopping centers moving into new areas like our townships and our rural areas. But there are also some new property types that we are seeing as well. Things like student housing is becoming an important one in the South African context, as well as we're seeing more and more of people, of the population, gaining access to higher education. So the demand for housing, for student housing, has increased quite a bit. And we're seeing these being commercialized and then being also made available for investment by private equity. And usually that is because in response to that, our universities may not always have the funds to build these residences for all of these students that they are now accepting into their universities. And this is where then the private sector, through private equity, who is being allocated capital by pension funds can assist in meeting this increased demand for student housing, while also gaining access to a new type of asset that can generate a return, so that the pension fund can also meet its obligations and also diversify its portfolio and protect it from some of the risks that we see in some of the more traditional areas of investment that we're used to. With the rise of e-commerce as well, we are seeing an increase in demand for storage, particularly within the logistics center, but also the self-storage market is where we are seeing an increase in demand, where people are wanting to be able to store their goods safely somewhere and not in their garages, as we've generally done in the past. And so storage units are becoming quite a lucrative way in order to meet that demand, and also to facilitate investments into this new type of real asset. There are a number of companies that are listed in the Johannesburg Stock Exchange that can offer some access to this new market, this new type of property that is meeting a new demand for this type of space. Storage is one of them, which is also a real estate investment trust, but with a focus on storage units, particularly self-storage as well. But warehousing and other in the logistics center, where you can store goods before they're distributed off to customers, is another area where we've seen quite a bit of growth, and where the private equity firms are playing quite a key role in developing some of these properties, where listed real estate investment trusts are also playing a key role in developing some of these properties, where e-commerce giants are coming into our shores and we're developing some of our own. You might think of Takealot, you might think of Amazon, who are now providing the demand that we need in order to be able to develop these things viably, and also then presenting an investment opportunity for pension funds, either directly or by allocating capital to private equity fund managers who have a focus on that particular type of property as part of their investment strategy as well. Healthcare real estate, as we seek to provide universal healthcare, as we seek to serve unserved and underserved markets, as we innovate around business models that keep healthcare affordable in communities that were previously unserved by existing private healthcare providers, or in supplementing public healthcare provision in some of these areas, we are seeing that is also turning into quite an important investment area for both private equity as well as pension funds that allocate to private equity and want some exposure and want to invest in a way in which has a social impact. And so by investing in healthcare, in housing, as well as in retail developments in rural and township areas, there's quite a bit of an opportunity there in order to have a social impact through the money that is allocated for these types of investments. Access to healthcare into unserved markets, retail and shopping centers that can create jobs, that can create an environment in which entrepreneurship can thrive, that can also create opportunities where small businesses can plug into some of the value chains of these new investments in our communities, as well as into previously unserved and underserved markets, are all ways in which investments into these real assets and these emerging types of properties with innovative business models that keep access to them affordable can be facilitated through the allocation of capital as well. And we're seeing quite a few impact funds that are saying that we, as a private equity fund, as private equity managers who want to raise money from pension funds in order to make these investments, we're going to focus on the provision of providing access to healthcare services to unserved and underserved markets. And we're going to have that social impact, but also generating a financial return so that the pension funds that we have raised money from, that have invested in us, can also meet their obligations to their members. And we also want to invest in building these things in the areas in which the members of these pension funds live, work, and play as well, so that they have access, so that they can see that their contributions are not only going to take care of them once they've retired, but are also bringing services that may have not been available to them in the communities where they live as well. And so real assets like these innovative business models are providing quite a unique opportunity, not only to have all the financial benefits of a diversified portfolio, as well as some protection from some of the risks in that we face in our economy, but also to be impactful in the lives of members and beneficiaries of the funds, as well as in servicing underserved and unserved markets with the type of services that you would generally find in the more affluent areas of our provinces and of our cities as well. Now, there are a number of ways in which an investment can go into real assets, and one of those ways is in an operational real asset, where you're not just investing in the asset itself or the underlying building or road, but in the business that also manages these assets. This is what we mean by operational real asset. And a nice example, and we just spoke now about storage, which is a real estate investment trust, which builds storage units that people can come and bring their goods that they want to store to free up some space in their garages or in their backyard at affordable rates. You're not just going to then invest in just the storage unit itself and collect the rental from person A or person B who has brought their goods into that unit, but you're also investing in storage as a business. So however else it makes money is a way in which that you can also earn a return from that investment. That is an operational real estate investment there. Another great example is hotels, restaurants, petrol stations, resorts, golf courses, and all of these things that we see around our neighborhoods and around the cities that we live in, where there is the asset, the underlying real asset there, but there's a business that is on top of that asset, that is running, that is generating an income, that is generating a profit. You can participate in that when investing in operational real assets. So just not the asset alone, where your only return is its increase in value over time, but the business that manages it is another opportunities where you can maximize some of your returns as well. But there are some key factors that need to be considered in investing in operational real assets, and that the people that you invest in or the people that you partner in, you need to know who they are, you need to know what their track record is in terms of operating some of these assets, so that you can benefit from that business and the operationalization of these assets as well. And also to be careful of how much debt that is on the books of the operational asset that you are investing in, as well as the debt that perhaps you might use to leverage your investment into those real assets. Particularly in this high interest rate environment, allocators of capital, those serving on the board of trustees of pension funds, need to be mindful of these sort of factors when investing in real assets, as well as buying at the right time. Property is tied to cycles. The saying is that it is cyclical, right? And the time in which you invest in property becomes quite important. If you've ever bought a home, or if you've ever been exposed to real estate, you might sometimes hear the terms, it's a buyer's market, it's a seller's market. These are just the way in which we try to describe the cycles in which the property market goes through. When it is a buyer's market, that's the right time to buy, where the property values are stable and reasonable. The interest rates are at a reasonable price, so you're going to get a good deal for your mortgage as well. There's not a lot of demand. There's an oversupply of properties in the market. That's what affects the value of the property as well. That's probably a good time to buy. But where there's high demand, very little supply, high interest rates, property values are going up at a really fast pace, but you're going to pay a pretty penny in order to service that mortgage as well, or that bond that you take out in order to invest within that property. That's generally some of the characteristics of what we would refer to as a seller's market, where the person that is selling the property is in a good negotiating position for price, and a buyer's market is where the person is buying the property is in a good negotiating position in order to negotiate the price of investing in that particular profit. But perhaps this now would also be just a good time to go back to what we said in the beginning about trying to differentiate between real assets and financial assets, and maybe just provide some examples. And this is a great infographic that shows this distinction quite well in terms of what you would generally find under real assets and what we would generally classify as financial assets. And like we said, investing in the money market and just earning a fixed interest rate, this is what we call cash. Cash is a financial asset. That investment is money in the bank or in an account somewhere, not something tangible that you can take home with you. Investing in bonds, whether these are bonds that are being issued by the government or bonds that are being issued by a company that is listed on the Johannesburg Stock Exchange, or even a privately held company. And all what a bond is to issue debt that you can invest in, and you get a fixed interest rate or a coupon rate that you receive as your return for investing in that. And when the bond matures, so at the end of its life, so it could be a 2-year bond, a 5-year bond, a 10-year bond, at the end of that life of that bond, that's when you receive the money that you had borrowed to either the government or to a company back. And that will be then part of your return, plus the interest that you had earned over the life of the bond. And also there are shares in which that you can invest in as financial assets, shares in a company either that's listed on the Johannesburg Stock Exchange, or shares in a company that is privately held, where you earn money based on whether or not the price that you paid per share is that going up, and therefore opening up an opportunity where you can sell your shares at a higher price than what you bought them for, however many years ago that you had bought those shares. And if the business is profitable and generates free cash, then dividends could be paid out to shareholders either on an annual basis, sometimes twice a year, depending on the performance of the business and its dividend policy. That's how you can then earn a return from those shares. But you're not taking anything physical, tangible that you can hold with home with you. This is something that is on a spreadsheet somewhere to track whether or not you are earning money or a return from your investment in those shares. And this is opposed to what we've been talking about here today, being real assets, property, the building that I'm in, that Sandy is in, that you're in, infrastructure, the roads that we use, the trains that we get into, the pipes that deliver our water, the electrical lines that deliver electricity when we're not being load shedded on a day-to-day basis. These are infrastructure. These are real assets that we can see, that we can touch, that are physically there and that are tangible. Commodities, gold, silver, and even if you do invest in some of these commodities on the stock exchange, there is an option to take delivery of those things that you've invested, or those commodities that you've invested in. They actually exist. They're actually there somewhere, that you can invest in order to protect your money either from inflation, from increased interest rates, if you are on the wrong side of those interest rates, or if in order or to protect your money from falling stock prices, if you're invested in shares on the JSE, and you just want your money to stay somewhere, to be stored somewhere with that is stable and that is predictable and that generally increases in value over time. And of course, we also spoke about natural resources as well as collectibles, rare art. Some people also invest in rare cars or in watches, timepieces that would generally, because they are scarce and because there's high demand for these types of things, that they would generally increase in value over time. These are also some examples of the real assets that you can invest in order to diversify your portfolio. So please also have a look at this digital publication, and you can see here, even just under this infographic that we have just gone through, which we won't go into too much detail into here today, on how some of these assets that we were speaking about, how they behave under a high inflation scenario as well as under a low inflation scenario, just to drive home the point of one of those reasons why we would want to invest in real assets. Just to illustrate that point, this infographic here gives us a short description of what you can expect the behavior of these assets to be in terms of their value in a high inflation scenario, as well as in a low inflation scenario as well. But coming now to the maybe the focus of this particular conversation around real assets, being that of private equity, and why private equity can be an important consideration to make when pension funds are allocating capital, and also wanting to get some exposure to some of these real assets. And one of the ways, and some of the reasons why private equity becomes attractive, as a means upon which to gain access to some of these assets, is that more often than not, a lot of these assets are held privately. So they are not on a public exchange where you can just go to a broker that can facilitate your investment into some of these assets, but are privately held. And private equity fund managers often have exclusive access to privately held companies that hold some of these assets, or in these projects themselves. You can think of infrastructure funds that in their portfolio might have a company that is responsible for developing and building some of these network towers that the big network companies like Vodacom and MTN use to deliver network to our phones. You may invest in Vodacom and MTN on the JSE if you want exposure to that business as a whole. But if you think, no, just the tower business might be where I might earn a better return for the amount of risk that is associated with that investment, then you might want to look to a private equity firm as a pension fund trustee, or someone who's making an investment decision within that space, that is a focus on finding these businesses and investing into them. And generally, the private equity fund manager who is doing so is someone with deep industry experience and the relationships that give him exclusive access to some of these companies that ordinary people like yourselves and myself might not even know about these companies, or how they operate, where they operate, and who the operators are of these businesses, but we would like to participate in their growth as well. Private equity is also a great catalyst for growth. These are generally investors that come in with a singular objective of helping that business to grow and to maximize returns, and to maximize returns within a reasonable time frame based on the type of assets that they like to invest in. So they've got a focus in helping these companies grow. They've got the time, the energy, the expertise, as well as the experience and the track record to know what will be required in order to grow these businesses for our benefit as pension fund members who have allocated capital to that private equity fund manager to invest on our behalf into some of these real assets that we may not have direct access to. As well as of the long-term nature of private equity is well suited to the obligations of a pension fund and when they would require the liquidity in order to be able to meet their objectives. So the long-term commitment nature of private equity who commit their capital for an extended period, giving themselves time to do the work that is required in order to grow these businesses and to maximize returns is well suited as well to the investment horizon of the pension fund, who is accepting contributions today, but will probably only need to start paying those out much later or in the longer term as well. So there isn't a mismatch there between when you can expect a return from a private equity fund manager who has raised capital from the pension fund in order to invest in some of these assets, with what the obligations of the pension fund to make benefits available to members when they retire as well. As well as pension funds are quite equipped to generate returns for investors by various means in terms of selling their stake in the company, in terms of an exit to another pension fund that perhaps is looking for more mature businesses. If the private equity fund that we had allocated capital to comes in a bit earlier in the growth stage of the business, or are able to facilitate a situation where the companies that they have invested in have grown to such an extent that they are now ready to be listed on a stock exchange, and therefore the private equity manager can either can facilitate that process with investment banks, with brokers, in order to get the company ready for its initial public offering. And all an initial public offering is the first time upon which a private company is making its shares available to the public by listing them on a public stock exchange. We do have publications that do go into a little bit more detail around what an IPO is. So please do check out the website and some of the content that we have up there for you, including infographics, videos, and sound bites. And you may find one that goes into a little bit more detail around what an initial public offering is, as well as how to invest in the stock exchange, if you are interested to know that. Another benefit of investing in private equity to facilitate our access to real assets is that it is also decoupled, which means it isn't linked to the short-term volatile movements of the public markets or the changes in the economic environment to a large extent. Yes, they are impacted by those, but because they are long-term, they're in a position to ride out some of these impacts as well, particularly those that will generally be short-lived and it's just a function of the business cycle or the economic cycle or the area of the economic cycle that we're in at that given point in time. So that long-term perspective, that focus on long-term value creation, that focus on working with the companies that they are invested in, bodes well for maintaining that protection against some of the short-term risks that we're faced with on a day-to-day basis in our economy. And it also creates some flexibility in order for them to adapt to some of these impacts of the economic cycles as well. Because it's equity backed, there is greater adaptability and agility throughout economic cycles. We usually call this patient capital. and so that they're able to ride out some of these economic challenges that we go through from time to time. And also because they're working so closely with these companies, are able to identify when we are coming out of those hard times, and the time has come for us to exploit some of the opportunities that are becoming available within the economy to continue to grow these investments, and to continue to set them up for greater profits, and also for greater increases in the value of those assets as well. Private equity also is important for its risk return profile. So the amount of risk that is associated with private equity is well compensated for by the return that you can expect from allocating to private equity as well, which is not always the case when investing in equities or directly into a property. But through private equity, facilitating that through private equity by allocating to a private equity fund manager, you're able to generally, in more instances than not, earn an adequate return for the amount of risk that you are taking on by investing in them, particularly with the view of investing in them in order to gain access to some real assets as well. And so why is this all important for retirement and pension funds? Is that some key issues that need to be taken into account when allocating members' money, is things that we have spoken about in our conversation here today. The first, diversification. It becomes, and this is why Regulation 28 has been structured in the way that it has, in order to be able to improve the ability of those at the helm of making investment decisions on behalf of pension fund members and beneficiaries, to diversify those portfolios, to protect member money from short-term volatility or any shocks to the economic system that may cause the fund to lose money, as well as impair the value of some of the financial assets that pension funds are invested into. So diversification is about protecting against those risks. It's about not putting all your eggs in one basket and hoping for the best, but actively managing the areas in which you seek to make a return in order to meet the obligations of the fund, as well as the needs of members and beneficiary as well. Private equity can also be quite catalytic in spurring about innovation in many of the sectors where you would find real assets. We saw some of these emerging property types or property investments that we've spoken about briefly. Those wouldn't have been possible if there wasn't capital that was willing to risk on those innovations, in order to be able to see them being developed and getting the kind of support that they are now receiving from the broader market. The private equity types, the venture capital funds are often willing to go where no one else will go, or who are more limited by their mandates, in order to extract value with some of the innovations that we're seeing within our economy as the times go by and as changes happen within our economy as well. And because of the long-term nature upon which that they invest, we also want to protect ourselves against short-term volatility, or at least mitigate the risk that we might be adversely impacted by the short-term volatility that we see in our economy. And by diversifying where we allocate capital, either through private equity, through property, through infrastructure projects, we are managing risk. And risk in these terms is simply the probability of a permanent loss of capital. The chance that we might lose our money is the risk that we are trying to protect ourselves against by diversifying our portfolios, and by looking to real assets in one way or the other in order to have in our portfolio assets that are stable, that provide a steady income, that can also provide benefits or value in the long term when we will need it, the most. And so we foresee that private equity, and as we continue to evolve within our economy and within the sectors of our economy, will increasingly play a role in developing these business models, in facilitating exposure to some of these innovations and into these real assets that can provide protection as well as long-term value for pension funds. They will become increasingly important in order to do so, as well as to fund expansion of some of these assets and the benefits associated with them, particularly from a societal perspective, into our communities and into those markets that in the past have either been underserved or unserved at all, in order to drive the growth of some of these assets and their ability to generate returns for investors, which include pension funds who are managing the contributions of members, as well as for the sake of beneficiaries as well. And so real assets can be an important component of an investment portfolio for all of these reasons that we have spoken about today. Number of ways in which we can gain access. Private equity will become an important one moving forward, as we see a greater appetite for these assets. We are seeing more private equity fund managers who are building the track record, building the expertise, building the relationships in order to identify these investment opportunities that can be beneficial to pension fund members and their beneficiaries. And so we felt it important that we have this conversation with you today. Thank you again to FETRI and the CISA Foundation for making this, and the CISA Academy as well for making this possible to have this conversation around real assets and the role that private equity can play in facilitating access to this important asset class. Let's pause there for now, and perhaps hand it back to you, Sandy.
Thanks so much, Kuma. That was very insightful. Thank you for taking us through real assets, giving us a great overview, and also linking it to private equity. Thanks for helping us understand how private equity links to real assets, what real assets are, and also why we should be interested in having a conversation such as the one that we just had. So if you have any other questions or you are interested in having a deeper look or dwelling deeper into the topic of real assets, you can go and have a look at our Atleha-edu website, where our latest publication has been loaded. The publication Understanding Real Assets, where we speak about traditional and alternative approaches, and then also just some other content relating to any of your retirement or trustee responsibilities, or also if you're just looking for any information regarding investments. If you're not sure where to start, Atleha-edu would be a great place. And our content comes in various shapes and sizes. We have our longer publications, such as the one that Tuma just took you through, and then we have shorter articles, such as the private equity article as well. And then we've also got some infographics, as you've seen in this publication, and also video bits for those who are more visual learners. But yeah, thanks so much. That is it for today. Thanks so much, Tuma, once again. And then also thank you to our funders, FETRI and the CISA Foundation. And I hope that this dialogue series was beneficial, and that you'll be able to carry this over into your responsibilities as a trustee, or just carry it or use it with your day-to-day investing. Thanks so much.